All right, let's jump right in. Welcome to This Explainer. I'm your host, and today we are conducting an Accounting Standards Codification, or ASC, Technical Accounting Masterclass, specifically focusing on the balance sheet. Look, if you're a staff accountant, a financial reporting manager, or maybe you're just staring down an upcoming audit and feeling the pressure, you are absolutely in the right place. Our goal today isn't to just sit here and recite dry textbook definitions at you. We are going to dig deep into the practical mechanics, the core accounting models, and the exact areas that require your professional judgment during a period close. We want you to walk away from this session with the real-world implementation knowledge you need to prepare bulletproof entries and confidently support your conclusions during even the most rigorous audit reviews. So let's get to work.
Here is our roadmap for today's masterclass. We'll start with number 1, the balance sheet foundation. Number 2, assets, current and non-current. Number 3, liabilities and owner equity. Number 4, preparation rules and pitfalls. And finally, number 5, audit readiness and controls. We're covering everything from the foundational rules all the way to surviving that final review.
Section 1, the balance sheet foundation, the bedrock of financial position.
Okay, let's dive into this. To really understand this foundation, we have to answer 3 very fundamental questions about a business. What does the company own? What does it owe? And what is retained for the owners? And the answer to all of that sits right here in the mathematical foundation of double entry accounting. Assets must always equal liabilities plus equity. We talk about this like it's day one stuff, but I really need to emphasize, this is not a convention. It's not a preference. Every single period close must leave this equation in perfect balance. If it doesn't balance, it's not a draft. Actually, scratch that. It's just wrong. A recording, transposition, or mapping error has occurred somewhere, and you have to stop and investigate.
And honestly, comparing these statements brilliantly illustrates why the balance sheet is so unique. When you look at the income statement or the cash flow statement, those cover a period of time, right? Like a whole year or a whole quarter. But the balance sheet is the only core statement tied to a single specific date. Think of it like a photograph. It captures the company's financial position at an exact moment, frozen in time, usually at midnight on the last day of a month, quarter, or year.
Section 2, assets, current and non-current, what the company owns and controls.
So fundamentally, an asset is any resource the company controls that is expected to bring future economic benefit. But in financial reporting, we can't just lump them all together. We must classify them. The absolutely critical split here is between current and non-current. Current assets are your short-term resources. We expect these to be used up or converted to cash within the next 12 months. To put that into perspective, think of a jewelry retailer's finished inventory sitting in the display case, or your everyday trade receivables. Non-current assets, on the other hand, provide long-term value well beyond 12 months. This is your heavy production machinery or a 5-year enterprise software license. This split matters immensely because banks literally use it to calculate your company's short-term liquidity.
Now, I need everyone to pay close attention to this next point because this is a massive watch out. Restricted cash must never be combined with unrestricted cash, period. If your cash is locked up by a lender, a contract, or an escrow agreement, it has to be broken out onto its own separate line on the face of the balance sheet. And yes, even if the restriction only applies to a small portion of a single bank account, you still must separate it. Trust me. Auditors test this specifically. They will request bank confirmations and review your restriction agreements just to ensure this exact presentation requirement is met.
While we're on the topic of assets, let's clear up 3 valuation terms that constantly trip people up. Depreciation is the systematic reduction of tangible fixed assets, like a building. Amortization is the exact same underlying concept but applied to intangible assets, like a patent. Impairment, though, is completely different. Impairment happens when an asset's book value is suddenly higher than its recoverable amount. For example, goodwill is not amortized. Instead, it is tested for impairment annually. When an asset is impaired, you have to record a specific journal entry to debit an impairment loss on the income statement and credit the asset to write it down immediately.
Section 3, liabilities and owner equity, what the company owes and what remains.
Moving to the other side of our equation, liabilities represent present obligations to transfer economic value in the future. Essentially, it's what the company owes. Just like assets, they are split by that golden 12-month rule. Current liabilities include things like accounts payable and accrued wages, bills due soon. Non-current liabilities are your long-term obligations. But here is a strict preparation rule you need to commit to memory. Deferred tax assets and deferred tax liabilities are always classified as non-current. It literally does not matter when the underlying temporary difference is expected to reverse. Lock that rule in right now.
So let me pose a quick question to challenge your understanding of this 12-month classification rule. Say you have a standard 5-year long-term loan sitting on your books, but a portion of that principal is scheduled to be repaid next year. What happens to it on the balance sheet? The answer is that it must be split out. The current portion of that long-term debt has to move up into current liabilities. Guys, this is a major red flag moment in any financial review. If your preparation team fails to update the debt maturity schedule every single period, you're going to leave that next 12 months of principal sitting down in long-term debt. And why is that bad? Because it overstates your non-current liabilities and dangerously understates your current liabilities. You have literally warped the company's risk profile to any outside reader.
Let's look at the final piece of the equation, equity. This is the residual interest left for the owners, the whole shebang. You have share capital, additional paid-in capital, retained earnings, and treasury stock. The absolute crucial point here is that retained earnings acts as the vital bridge between your income statement and your balance sheet. Every single period, your opening retained earnings plus net income minus any dividends paid must equal your closing retained earnings. If this roll forward doesn't reconcile perfectly, it means something was posted directly to equity improperly, and you've got an error to track down.
So why do we obsess over this? All of these classifications, splitting current from non-current, culminate in this absolutely critical metric, working capital. It's just current assets minus current liabilities. Management and your lending banks watch this constantly. A positive number indicates healthy short-term liquidity, meaning the business can safely operate and pay its bills. A negative number? That signals a severe potential struggle to pay suppliers and staff.
Section 4, Preparation Rules and Pitfalls, Flawless Execution and Common Errors.
Now that we have the accounting mechanics down, how do we actually build this statement flawlessly every month end? There are 5 non-negotiable rules for your close process. Rule 1, it must balance, always. Rule 2, reassess classification every period. Please, never blindly roll forward last month's current/non-current splits. Rule 3, reconcile every single line to source data. Rule 4, separate restricted cash. And Rule 5, always show the prior period for comparison so you can ensure consistency.
Let's look at where things usually go off the rails. A huge trap is missing the GRNI accrual. That stands for goods received, not invoiced. Think about it. If you receive a shipment of raw materials into your warehouse on the 29th, but the vendor's invoice doesn't arrive until the 3rd of the next month, you still owe that liability on the balance sheet date. You must record a journal entry to debit your inventory or expense and credit an accrued liability. If you skip that entry, you violated the completeness of your balance sheet. Another massive trap is just lazily lumping all deferred revenue into current liabilities. You absolutely must review your contract delivery timelines to see if any of those obligations extend beyond 12 months.
But right here is the most critical watch-out warning of this entire explainer: debt covenants. If your company violates a debt covenant metric, and you do not have a qualifying waiver in hand from the bank prior to the issuance date, the entire loan balance must be reclassified to current liabilities. Not just the next installment, the whole thing. This is a catastrophic error if missed, because dumping a massive long-term loan into current liabilities will instantly destroy your reported working capital metrics. Section 5, Audit Readiness and Controls. Surviving rigorous review. For this final stretch, we are going to shift our perspective entirely to the auditor's lens to help you build your balance sheet defensively. When auditors test your balance sheet, they judge every single line item against the 5 audit assertions: existence, completeness, accuracy, classification, and rights and obligations. Now, what's really interesting here is that these assertions aren't just an auditor's toolkit. They are actually the ultimate preparation checklist for your own finance team. If you proactively test your own work against these 5 pillars during the close, your balance sheet becomes virtually bulletproof.
To actually enforce those assertions in the real world, you need a strict internal control workflow. The team member prepares schedules, updates the debt maturity, and flags any borderline issues. Then, the team lead reviews these schedules and classifications, looking specifically for high-risk items. Finally, the manager makes final judgments and approves disclosures. The absolutely critical operational consideration here is early escalation. If a team member spots a potential covenant violation, it must be escalated immediately, not on the very last day of the close. You need time to analyze the guidance, document your position, and potentially secure waivers from the bank. I want to conclude this masterclass explainer by leaving you with a bit of a provocative question. When you get back to your desk, I want you to look at your own internal controls, your reconciliations, and your period-end checklist. Can you confidently answer yes to all 5 audit assertions for every single line item on your balance sheet?
If the answer is no, well, you know exactly where to start improving your process tomorrow. Thank you so much for joining this deep dive into ASC technical accounting. Keep those equations balanced, watch those current classifications, and we will see you in the next explainer.